All right, let's take a look at another exercise. This one is on how to construct a balance sheet and compute working capital. So, what we're going to be looking at here is we've got some balance sheet accounts, and the first thing I'm going to do is I'm going to end up labeling these by assets, liabilities, or equity, because right now they're not in any kind of order. And then we're going to take a look at a couple of basic transactions here, and then we're going to adjust some, not all of those numbers, okay? And then working capital, just so we know, is current assets minus current liabilities. So this is going to give us a figure, hopefully a positive number. Okay, so I have our accounts here, our 8 accounts, and again I'm going to label them based on the accounting equation: assets equals liabilities plus equity. These are not in order again in any way, but accounts receivable, this accounts receivable represent a future benefit to the company, so we would call this an asset. Anytime we see the word payable, okay, anytime we see the word payable, we know that we have a debt or an obligation that requires a future sacrifice, and we call those liabilities. Equipment is also an asset. Now, it is a non-current asset, but it is nonetheless an asset. Okay, and I'm going to put, I'm actually going to change this to a non-current asset. So I'm going to leave this A here, and we'll just assume that that is a current asset, and that notes payable here, this is probably going to be a non-current liability. Supplies are a current asset because as we use those supplies, they provide some type of benefit. So we buy them, and before we use them, they provide no benefit at that moment. They provide the benefit as we go ahead and use them. Accounts payable, there's that word again, payable. So we have a liability, and accounts payables are current liabilities. Cash is the most liquid of all assets, and it is a current asset. Common stock is one of the 2 components of owner's equity, so I'm going to put an E right here. And then retained earnings is also a component of stockholders' equity. Okay, so I noticed that I don't believe that this is a part of the question. But as I kind of glance down through here, looks like we're going to be looking at some of these figures as of May the 31st, right here, and then we're going to be looking at some the next day on June the 1st. Okay, so what we need to do in order to get our retained earnings amount as of May 31st is we need to go ahead and add up all of our assets. So I'm going to start with the accounts receivable amount of $18,300. Add to that equipment. Now let's see, I did that wrong. $18,300 plus $55,000 plus supplies of $16,400. Okay, plus cash of $12,200, and that's going to give me assets $101,900. Okay, then I'm just going to write down my liabilities here, abbreviate slightly, and let's see here what we have. I'm going from left to right, so we have a note payable for $20,000 plus an account payable for $5,200. So, and that's the only other liability that we have. So we have liabilities of $25,200. So what that means is that total equity equals 101,900 in assets minus 25,200 in liabilities. And so that gives us 76,700. And I'm going to go ahead and write that down. But notice that's not really what I'm trying to solve for, because what I really want to know is what are my retained earnings on this date. So this is total equity. So all I have to do now is then subtract out the common stock portion of equity, 42,500. I'm going to end up with retained earnings on this date of 34,200. So we don't get any points for that, but we're going to end up needing it, I have a feeling. Okay, so I'm going to clear this out, and let me kind of move this paper around if possible. May have to move our calculator out of the way for just a moment. Okay, so it says here then, assume that on June the 1st, only the following two transactions occurred. We purchased additional equipment costing $15,000. Okay, giving $2,000 in cash and issuing a $13,000 note payable. All right, so we made basically a $2,000 down payment, and we paid $2,000 in cash, and then we also declared and paid a $7,000 cash dividend. Now, we do not declare and pay dividends on the same day, so I would say that we'll just pretend that we declared it at some point in time in the past and that we paid the dividend on June the 1st. Okay. So now we can start filling in our balance sheet. And so the first thing it asks us for, we don't have to put anything up here. That's just blank space. The first thing it asks us for is cash on May 31st. Well, we have that information provided to us right here. So all we have to do is plot that in there. Okay. Now, if it were me, I would go and I would consider those two cash transactions. Our cash balance, let's see, where can I move this? Our cash balance went down by $2,000 here for the down payment on the equipment, and also again here. So we have $12,200 minus the $2,000 down payment, minus the $7,000 in dividends paid, and that gives us $3,200 for cash on the next day. Okay? All right. So one of the things that we can kind of learn here is that we're going to order our assets in the order of liquidity. So first thing we want to do is notice here we've got cash they provided us, and we have a spot here, here, and here. So we should have 4 assets in total, and if we look up here, we have accounts receivable, equipment, supplies, and cash. Okay, and we already did cash. So accounts receivable is kind of the second most liquid asset we have, and there was no change to accounts receivable, so we can just go ahead and write accounts receivable, and then what we'll want to do is we'll want to say it was 18,300 on May the 31st, and it was also 18,300 the very next day. Okay? All right. So supplies, also a current asset, and supplies are not necessarily liquid, but they can be exhausted before the useful life of our equipment goes away. So supplies are going to be our next item. We don't have a lot of items here, thank goodness. And we had no transactions involving supplies. So all we have to do is say, okay, it was 16,400 yesterday, and it is 16.4 today. And then finally, equipment, which is our long-term asset, was $55,000 on May the 19th. However, we purchased $15,000 of equipment on June the 1st. So I'm just going to do this kind of without using the calculator. 55 plus 15 is $70,000. Okay, so that's where we have had some changes. Okay, and then let's see here now. We have two spaces for liabilities. Okay, and if we look back up here, we have a non-current liability, notes payable. Now I'm assuming it's a non-current liability. It doesn't have to be, but probably is. And then we also have accounts payable. So I'm going to go again in the order of current, non-current, and I'm going to write A/P for accounts payable. And there was no change in this figure. No change. So we can just plot 5,200 for both days. Notes payable, however, there was a change. So that's our other liability. And it was $20,000 yesterday, but notice we issued an additional $13,000 note payable on June the 1st. So now we owe this $20,000 for whatever that was, plus this $13,000, and so that's going to change that figure to $33,000. Okay. All right. We have two components of stockholders' equity. We have common stock, and we have retained earnings. And do make sure that you understand, at least generally, how we get common stock and how we get retained earnings. Okay? So we actually already did this, part of this. Our common stock on May the 31st was $42.5. And we didn't have any additional owner contributions, so it's still $42.5 the next day. Retained earnings, we actually went ahead and calculated up here. I'm not sure we were supposed to do that, but we did it, so we might as well use that number. Okay? All right. So, at this point in time, what I would do is I would total these numbers up. You might do this in a different order than what I do, and that's perfectly okay. So there is a box here that needs to be filled out, so let's do that for the May 31st assets. 12,200 plus 18,300 plus 16,400 plus 55,000 equals 1019. Now we already had that figure, and then we also have our liabilities here for 25.2. So since we already did this, we can just kind of drop it in right there. And we also calculated total equity up here, 76.7. We already did that. So we'll just go ahead and use that information. So we've got this figure here on the calculator for our assets. Notice that right here we're being asked total liabilities and stockholders' equity. Since we already have the 101,900 for our assets, we can then subtract out liabilities minus 76.7, and that should take us to 0, meaning that our total liabilities and stockholders' equity is this same 1019. Okay. All right. We also need to calculate total assets as of June the 1st. So we haven't done this yet. So we've got $3,200 in cash. We have $18,300 in receivables. We have $16,400 in supplies. And we have $70,000 in equipment, giving us total assets of $107,900 the next day. All right. And then our liabilities have changed as well. $5,200 did not change. That's our accounts payable plus the $33,000 note payable gives us $38,200. Okay. And so what we can do from here is we can say, okay, 107,900 minus 38,200 equals 69,700. Now, we're going to see if that's the truth here in a little bit, because if it's not, we'll have to erase it. Okay, that's total. That's total stockholders' equity, and then we can say, okay, well, if total stockholders' equity is 69,700, we can do this in a couple of different ways. We could take, but we've got our 69,700 here. We can add to that liabilities, giving us 107,900. And we also have this little box right here. So, you know, if we have total stockholders' equity of 69,700, and 42,500 of that is common stock, within 27,200 is retained earnings. And this should be fairly easy to prove because we had, let's see here, right here we had 34,200 in retained earnings. Now we're saying it's 27,200. And how did we get there? This $7,000 cash dividend. Cash dividends are paid out of earnings. Therefore, that $7,000 is no longer retained. So I'm going to tighten this up just slightly there. That looked like a different number. And so here's our balance sheet. Okay. And this video has gone on for quite some time, but at this point we might as well go ahead and finish. It says calculate its net working capital at June the 1st. So we're going to be using these figures. So again, the formula for working capital is simply current assets minus current liabilities. So we have to figure out what these numbers are. We've got total assets of 107,900 minus the one long-term asset, equipment, 70,000, gives us current assets of 37,900, and we're going to subtract from that our current liabilities. We only have one. It's 5,200. So if we take 37,900 and subtract from that 5,200, we come up with $32,700, and that is our answer.